On this first Tuesday of February, as part of the new 2020s, the new decade, the RBA had a tough decision to make today. They had some really positive economic data flowing through from the end of 2019. That consisted of a really good unemployment story. It also said that retail spending had a bounce in November, so that was positive. And ultimately there was also some okay inflation data, which we'll get to in a minute. So has the RBA kept the cash rate on hold? That's a good question. The second part of that though is on the cut argument, and the cut argument consists of, the economy moving forward is going to face a lot of headwinds. Firstly, we've had a horrible bushfire season, lots of lives lost, tragic circumstances, thousands of properties are being destroyed. So from that point of view, that's going to have an economic impact. We've also seen the other big news really around the coronavirus out of China and what that's going to mean for the economy here. Obviously, tourism numbers, the federal government on the weekend also deciding to ban travel into Australia from China to try and stop the spread of the virus, and also what that means for one of our other biggest exporting industries, which is our education industry. So with that in balance, so what did the RBA decide to do? Well, they've kept their powder dry and they've kept the cash rate at 0.75. And that's on the back of those unemployment numbers. And they want to see some more data coming through to see exactly where the economy is moving. Now, on the back of the coronavirus and what's going to happen there and the impact of the Australian economy, there's probably still a very strong chance that we're going to see a rate cut either in March or April of this year. So all they've really done is prolong that decision, and so we will see what we're looking at there. Now, let's take a look at some of the economic data supporting some of those decisions, and as we do around the grounds. So looking at the overseas markets, the three biggest stories over the last couple of months have really been these. And we've been talking about the first one for quite a while, and that is that the US and China signed their phase one trade deal. Now that has really meant that most global economies and the outlook for the global economy has been more positive, and we've seen that reflected in regards to the share prices only until recently, which is another big event which I want to talk about. But effectively what we have seen is that phase one deal's done. Now we get some certainty around global trade and what's happening in the US and China, and we've seen those equity markets really pop. Now, the second news story, I will acknowledge it is the Brexit story. So we saw just recently that the UK has left the Brexit, the United Kingdom has left the Brexit, and so we will see that transition take shape. Now, in terms of what does that really mean for the Australian economy? Not a lot. We're not a big they're not a big trading partner of ours, but still any strong free trade agreement with our trading partner and obviously old friends in the UK, that would mean a positive news story for us. But I don't think it's material enough to say that it's going to be a bonanza for our economy here. Finally, the story that I mentioned earlier, the coronavirus. This is a developing story. It is a significant event, obviously from a health perspective, but also economically. We saw the Australian government, as I mentioned, in terms of banning travel from China into Australia to stop the spread of this virus as they work on a vaccine. We've obviously seen the US do the similar things. So globally, as this story develops, it is going to have an impact on the global economy. And we've definitely seen that in terms of the last couple of days on the equity markets. The Chinese market is obviously reopened after the Chinese New Year with significant falls, US down significantly, the Australian market down significantly. So that is playing out as, I suppose, the risk appetite grows around what's happening in terms of this particular virus and the spread. So, that is still going to have some way to play out. Hopefully, a vaccine will be developed and we will get on top of that particular virus. But that is definitely going to be a significant impediment in regards to global growth. And so we've got to keep an eye on that. When we turn domestically, certainly, as I was saying before, the experiences with the bushfires here in Australia has been tragic. Thousands of properties lost, other assets included in that. So From an economic point of view, we will see obviously governments having to spend more in terms of not only fighting these fires at state and federal level. There's also the recovery program, the rebuild program, which is going to cost many, many millions and potentially even billions of dollars to see that restored. In addition to that, we've still got the ongoing challenges around the drought in certainly outback Queensland and New South Wales. That's continuing to negatively impact our economy. So that's also an important measure for us to consider. When we go to the inflation data, we did see the headline inflation data push higher, which was a little bit surprised. Most economists didn't think it would go that high. Headline inflation was up 0.7 for the quarter, while the trimmed mean measure rose just 0.4. The annual rate of inflation sits at 1.6, which is below the 2 to 3% target range for the RBA has set itself. Now, what was in that data? Fruit prices up 6.8% over the quarter. Beef and veal prices rose 2.9% on the back of those drought conditions that we mentioned. Higher oil prices also led to a 4.4% rise in automobile fuel prices, and higher tobacco taxes has also flowed through with an 8.4% increase on tobacco. So kids, everyone, don't smoke, it's not good for you. In terms of non-tradable inflation, that jumped 1% in the December quarter. Now, this is the biggest quarterly gain in nearly 5 years. And what this reflects is, because it's important to understand what is non-tradable inflation, this is what we talk about when our Australian dollar goes down. So when the dollar goes down, our imports cost more to bring in, and we obviously pass our margin on, retailers pass their margin on, and that flows through to higher prices. So that is not something that we can manage easily, because if those goods cost more to acquire and import, that's obviously going to flow through to the inflationary price. In terms of the contrasting, which is tradable inflation, which is basically where demand and supply is really taking shape, we did see that only increased by 0.2. So again, we don't necessarily have that sort of price pressure based on wages pushing prices up to see that inflation move forward. So that would be still a concern for the RBA in regards to the trimmed inflation that we look at. In terms of unemployment, we definitely saw a strong number in the lead up to December. The December number data was really strong. We added 28,900 jobs, led mostly by part-time jobs. Obviously, our summer jobs, Christmas and summer jobs numbers was good. There was a minor fall in full-time positions, but overall, that led to the unemployment rate falling to 5.1%, and that means that we end the 2019 with the lowest in 9 months. So that's a good news story. That's the story in regards to what the RBA is seeing in regards to this positive data coming through. So let's recap the whole of 2019. We saw the Australian economy add 262,500 new jobs. Now, to put that in perspective, in 2018, we created 269,500 new jobs. So very similar to 2018. But 2017 was obviously a very strong year for job creation, where we created 415,300 jobs in 2017. Now, the other thing that we also now need to focus on more and more is the participation rate. So the labour force participation rate was steady at 66%. And that is what we're talking about in terms of spare capacity in the labour market. So there is still room for movement in regards to that. And that's why the RBA still maintains its focus on getting full employment, and that full employment figure looks around 4.5, to 4, maybe 4.75 as a full employment figure, which will put pressure on wages growth. So that's our unemployment story for the month of February. In terms of the credit and lending data, we have seen some positive stories here. So what's happening with credit is the declines in credit growth are stabilising. So we did see housing credit grow by 0.3% in December. The upswing in the housing market has been led by owner-occupiers. Okay, so they're out in force. They'll continue to be in force into 2020. they expanded by 0.5 of 1%, and there was no change in investor lending. As mentioned in regards to housing and mortgages, it's going to be one of those times where households with these low interest rates are going to continue to pay down debt and improve their balance sheets. So it's important to understand that when the Reserve Bank adjusts interest rates down, or we're at these historically low levels, that money is still flowing into the household. Whether we're spending it now or putting it into our savings or to pay debt down, it's still having an impact in regards to the overall economy. Now, on the back of the lending story, and I think there will be a housing pickup in 2020, we'll see more momentum, and so I expect those credit numbers to improve and continue to grow through 2020. We'll keep an eye in the coming months on approvals, building approvals. We did see some positive numbers coming out on the back of November's data. So we saw high-rise numbers improve, but they do bounce from month to month. So we want to see that trend line improving because, of course, construction and lending is only going to be led by those approvals starting to come through. So we'll keep an eye on that. In terms of business credit, we saw a 0.2 rise in December, and that's the second month in a row where we have seen an increase, but it's still overall annually unchanged at 2.5%, and there is still some concerns in the business sector, which I'll get into in terms of business conditions next. But there's uncertainty around the coronavirus, around what's happening at the domestic and global economy, and that is obviously leading to less business lending. Let's focus now at the Australian business conditions. What do they look like? We saw the NAB survey come in with some soft numbers. So business confidence fell to the lowest level since 2013. That's July 2013. Now that's going to be compounded by bushfires, which were occurring really early, if you remember, in December. The drought conditions, so that was playing out. And now we've got what would be considered some sluggish demand through the Christmas period. So the confidence index fell 2 points to be -2. The business condition index slipped 1 point, still +3. So the conditions still remain above the lows that we reached earlier in the middle of the year. So they've definitely improved as we started to see the RBA cutting rates. But they do remain below the 2018 averages, so we've got to keep an eye on that. And as I said, the coronavirus is going to play out negatively in regards to those business confidence numbers. So that's something we need to keep an eye on. Consumer spending. So we did see really positive numbers in November. I mentioned those earlier, led by Black Friday sales. It was the consumers opened their wallets. They became buyers again. And we did see retail sales record the biggest monthly gain in 2 years, a rising 0.9 of 1%. So a good news story there. I just wanted to highlight some of the best performing sectors. Department stores 3.4, clothing, footwear and personal accessories 3.1% up, which were the fastest growth rates for some time. Household goods saw a 1.2% rise, and while spending in restaurants and cafes also posted a healthy 0.9% rise over that time. Now, the December data, we don't get that until Thursday, so we can't report on that, but the commentary and the feedback so far has been that it's been a weaker Christmas and Boxing Day sale period, and so we don't think that the consumer has continued to keep their wallet open. And that's obviously not necessarily great for the economy because we need that consumption spending to improve, remembering that almost 60% of our GDP is on consumer spending. So it's important to understand that. Now I want to turn the attentions now to house prices. I don't put too much weight into the January result, so I want to focus in more on the end of the year. And the reason why I don't focus too much on the January result is because there's not a lot of activity happening in our big centres. It's mainly regional sales, and obviously with the bushfires and everything that's been going on, I don't suspect it's been a standard year or a standard selling season for our regional and seaside locations. So with that in mind, I don't think the data is reflective. So I want to again focus really on what happened in 2019. So the dwelling prices in December were up 1.2% for the month, which is the 6th straight month of gains. On the year, dwelling prices for the capital cities rose 3%, led by Sydney, which was also up 1.7, gain in Melbourne, also 1.4%. Houses are outperforming units at the moment, obviously with the larger concerns around medium and high density accommodation. The premium markets are the ones who have bounced back. So they were the ones that led the falls the most, but they have had a terrific rebound. They are up 5.6% in 2019 compared to only a 1.1% rise across the lower quartile. So the top quartile, the top 25% of properties have really bounced, and those property prices gains have been significant. So that's the story right now for the housing. I will talk more about the housing story in our podcast over the coming weeks as we've finished our summer series. So tune into some conversations around the outlook with Bryce and myself as we look in more depth into 2020 and what we think is going to happen in the property market. So in closing, the RBA has kept the cash rate on hold at 0.75 of 1%. I don't think it's going to stay there for long, given the economic headwinds that we are going to experience both globally with the coronavirus, but also domestically in regards to what's happening on the jobs front. So from my point of view, it's going to come. It's either going to be a March or an April cut, but for now, the RBA has kept the powder dry. Finally, again, on the property front, if you're thinking about investing in property, or you're going to make a downsize move or an upsize move, or you're a first timer coming in, it's always important at the start of the year to start doing your research. Really, really important. There is going to be strong demand from owner occupiers. We're seeing that out in the field. First time buyers, we're definitely seeing that happening out in the fields. Our buyers agents are getting that feedback already. Positively, we're going to see some new listings. So if you're looking to do your research, now's the time to start to see what's coming online, what new listings, because those new listings are going to flood in over the course of the next couple of weeks, and we'll start to see the new auction season starting to take shape. So get out there, do your research, get your understanding of value, and all the best in terms of your property pursuits for 2020. And again, if you need help, you know where to find us. So until next month, remember, knowledge is empowering, but only if you act on it.